Good evening, everyone. I welcome you to the second lesson in this training. In the last lesson, we stopped at price action. So we move here. We move from this place now. Now, price action describe the characteristics of a security price movement. This movement is quite often analyzed in respect of price change in the recent past. So in a simple time, price action is a trading technique that allows a trader to read the market and make subjective trading decisions based on the recent and actual price movement rather than relying solely on technical indicator. What we're talking about in this price action is that it's just a system whereby you use the past events to determine the present and know the future. A price action trader, they are the longest person in the financial market. This price action, also we can combine the price action with other technical indicators so as to know when and how far the market is really moving, where it's heading to, when you're supposed to exit at a particular point in time. You need to know when to exit. The price action can allow you to determine all those kind of things. Then let's move, because we're still going to demonstrate this price action in our practical class. Now, all technical analysis tools like charts, trend line, price band, high and low swing, technical level of support and resistance or consolidation are taken into account as the trader chooses, as a trader's choice and strategies. The study of price action is often the scope of what we're just trying to say here is that the price action is very, very important. Very, very important, because there is a way we could demonstrate a price action, and a price action trader can trade for the next 1 year without looking back. They are very very conversant with the price movement. Even a price action trader can tell you where market gets to in the last 10 years, and they will use it to analyze what is the present, and so that they can determine the future. So when we get to the practical class, we're going to demonstrate it. Market sentiment. Market sentiment is the sum of the attitude of investors towards a particular financial market. Market sentiment is the feeling or the tone of a market as revealed through the activities and the price movement of the security traded in the market. Let's say, for example, now the rising price will indicate a bullish market sentiment, while a falling price will indicate a bearish market sentiment. This sentiment we're talking about is just the normal general behavior of the market. Either the market is going up or is going down. So when the market is going up, we'll be talking about the bullish market, that the bulls they have taken over the market. So that is just the way the tone of the market, the way the market behaves at times. So market sentiment is generally described as bullish or bearish. In the forex market, the bullish market is also called a market whereby the buyers, the bullish market is a market whereby the buyers are dominating. So why the bearish market is the one the sellers are dominating. When the bears are in control, the stock price is going up. Also in the forex market, when the bears are in control, the market is going down. When the bulls are in control, the market goes up. The market is driven by emotion, so that market sentiment is not always synonymous with fundamental analysis. Market sentiment is always different from fundamental analysis, which means that market sentiment is also about feelings and emotion, whereas fundamental is about business performance. The difference between market sentiment and the fundamental analysis is just that the market can just decide to behave in a particular manner, whereby you'll be thinking that the bulls, they are in control, or the bears are in control. But when we talk about that, is just a sentiment of emotion. We will just assume that the bulls are in control, this market is uptrend. But when we talk about fundamental, something must determine maybe the market is going up or going down. Maybe the political instability in a particular country, or maybe there is a natural disaster in that environment. So that way, when such a thing happens, is an indicator of fundamental. So we move. Now, support and resistance. When we talk about support and resistance, a support, when the market is going down, when it meets an obstacle, why it was going down. The forex market is always, it's either a bullish market or a bearish market. So when a market is going up, the barrier that will meet on the road, just like the way you are seeing it on the screen, the barrier that will meet on the road while it was going up is called resistance. If the market is going down, it will definitely touch a particular barrier, which is called the support. Both resistance and support, they are very, very important, because that forms the basis of in fact, it's one of the most important aspects of this forex training, because you should be able to determine your resistance level and the support level. So you can also use that as a good strategy to trade. Imagine throwing a tennis ball. Is an illustration that we use to illustrate a kind of resistance and support. Imagine throwing a tennis ball on the floor really hard. It bounces and then hits the ceiling before and coming back to the floor, bouncing again. This is just an analysis of how to demonstrate resistance and support. The price is the ball, the support is the floor, while the resistance is the ceiling. So just get that analysis. Very simple. Support level represents the floor, the floors, areas where buyers tend to be, area where buyers tend to be strong. By knowing the support level, you can identify good buying opportunity. However, if the price falls below a support level, this is also a trade signal. As the support level becomes a resistance, resistance level is the opposite of support level, as they can act as the ceiling. By knowing the resistance level, you can also recognize the possibility of selling. What we are talking about in this scenario is that whenever you are whenever you are whenever you can identify your support level, is an opportunity for you to buy, because when the particular when the market touches the support level, is about going up. At the same time, when the market touches the resistance level, it's about going down. Let's move a little bit so that we can all this will be demonstrated practically. The reason support and resistance level exist the reason why they exist, because the market remember prices where buyers and sellers tend to cluster. What we're saying here is that market always repeats itself. When it gets to this position, maybe in the last 2 weeks, market gets to a particular price. This week, when the market gets to that position, whatever happens that time, it will repeat itself. If it touches, if a market hits a resistant line last week, if it gets to that level this week, it will still react. It will still behave like it will still react to that same price level. So that is what we're trying to explain there. We're talking about the trend line. Trend line is a term used to describe price moving in the same direction over time. When prices are generally rising, this is known as uptrend. And when they are falling, this is called the downtrend. Yes. Let me just quickly explain this. Price tend to trend only 20 to 30% of time, which means that the remaining 70 to 80% they are trading in a range or without clear direction. What we're trying to say here is that there's a particular level whereby there's a particular scenario whereby the price will move in a particular direction for a period of time. It might be a longer period. So when it is moving up, when you see a sequence of candlestick following each other in an upward direction, is called the uptrend. Vice versa, the sequence of a candlestick going down in downward direction is called the downtrend. But remember that trend is your friend, because this trend is very, very important. Let me show you now. Simple rule. This is a demonstration of an uptrend, a sequence of candlestick repeating itself in an upward manner. That is called the uptrend. So is a very good tool to trade if you want to follow the trend. We have some people, they are trend followers. Immediately they identify that this is an uptrend, they keep buying. They can buy for the next 6 months. We move. In uptrend, we look for two consecutive high and higher low is in an uptrend, we look for two consecutive high highs and high lows in an uptrend, and the third high confirms the uptrend. In a downtrend, we look for two consecutive lower lows and lower highs, with a third lower low confirming the downtrend. Now, what we're trying to demonstrate in this place is being done practically. When you want to identify the trend of a market, there are some things that you need to look into. So when you look into that, that is when you can identify that this market is an uptrend or a downtrend. So we move. For example, if you confirm a trend on 30 minutes chart, look at 4 hours chart, also confirm it there. But if you get the confirmation, go back to the first time frame and look for a good entry point. Remember that trend is your friend, meaning that it is less risky to trade in the same direction as the trend and than to go against it. For this reason, if you identify any uptrend, it is safer to buy. If you find a downtrend, it is safer to sell. What we're trying to say is that when you want to identify a particular trend, if you want to identify a particular trend so that it give you an opportunity to buy or to sell, you must first of all try to get a very good entry point, because if you don't have the good entry point, whenever you place a trade, it may run you to good negative before it can start buy. Maybe you saw an uptrend, you want to take a buy, and you did not spot a very good entry. It will first of all run you to good negative before you start buy. You will still eventually buy, but it will run you to good negative. So if you don't have enough capital that time, it might kick you out of the market. So that is what we're trying to tell you there. Spotting a market reversal. A reversal pattern is also a very important tool. Is also a very, very important tool in trading the financial market. Eventually, the price will stop flowing, following the trend, and fails to reach a new high or a low. It will hit and then reverse direction. Traders often use another rules to identify trend completion or reversals. During an uptrend, if the price reverses down and dipped below the most recent low, then it may be a sign that the uptrend has broken. Similarly, if the downtrend is the price, during the downtrend, the price bounces up and rise above the most recent high. So the downtrend may have come to an end. What we are trying to say here is that at times when you are trading, you may not know the time when the trend that you are following, you may not know the time it will end. So you should have the ability to determine the end point of your trend. Maybe it's an uptrend, you should know that, the trend has finished here, the trend has been broken. Immediately the trend's broken, the market will reverse back in an opposite direction. So that means that you still need some of these strategies to determine how to stop the market, why the market, or you can use the reversal system if you wish to trade the reversal pattern, which has its own technicalities. So why during the course of this training, we will demonstrate a particular strategy for you whereby you will be able to trade the reversal pattern. When the market is going in an upward direction, it won't just be going like that. It will get to a level whereby this market will reverse. So during the course of this reversal, you can also join the market. So we move. So this is how to draw a trend line, but this is more of practical aspect where you can see now that drawing this trend line, it look like as if the line a downtrend. So a sequence of repeated candlestick, moving in a downward direction. But as you can see this analysis now, the downtrend has been broken somewhere. Here. So this is where you're supposed to stop. If you are trading, this is where you're supposed to stop. If you are trading the downtrend, you're supposed to stop here. So when you stop there, that is maybe the market. You still need some other indicator to determine if the market has already wants to move up again. So we move. Yes, this is a very important aspect of this training. Popular indicators. We discussed earlier that there's what we call technical analysis. The technical analysis is the use of technical indicators to trade the financial market. These technical indicators, we have all of them on our platform, especially on the MetaTrader 4, even MetaTrader 5 platform, that we can apply to our chart. We can combine so many technical indicators with our price action, because indicators plus your price action is what we call strategy. There are so many strategies you can apply in trading, but the sake of this training, we're going to limit ourselves to some of the useful trading indicator that is relevant to this 21st century. It's not all of them that is relevant against some they are almost outdated, but at least we also have what we call custom indicators. These indicators are built based on the principle of this an existing indicator. So it's just customized, and you now import it, apply it on the MetaTrader. Some people, you can buy them and you now install them in your MetaTrader as a guide. So it's always very good, because the more tools that you gather together, the better for you. Indicator, they are technical instruments which guide the decision of a trader. So when they want to make entry, each indicator is suitable for different situations. So you need to know which work best for you. That's what we're trying to say. Like we're going to identify, we're going to talk about the moving average, we're going to talk about the relative strength index, we're going to talk about the Bollinger Band here. So looking at this, before choosing an indicator, you should first identify the market environment. The market can be in a range, or in a trend, or in a sideways manner with no clear direction. Once you have completed it, this quick analysis, you are ready to choose the best indicator you need. Note, I avoid using too many indicators at the same time because of the conflicting signal. Makes it so hard. What we're trying to say is that when you have too much indicator on your chart, you may not even be able to you get confused, and at the same time you may not really want to get the scope of what we're talking about. And this indicator, it can also be useful to identify a good entry and an exit point, because when you have a very good indicator compared to your looking at your markets, looking at your chart and everything, it will give you an exit or a very good entry. There are some indicator that gives entry, while some they give exit. So that means that you have to combine the two together to give you a better result. An indicator like moving average now. An indicator like moving average. So this moving average, it is more of we have like three types of moving average. We have the simple moving average, we have the exponential moving average, and the weighted moving average. This simple moving average is just what differentiate this moving average is all about their settings on the dashboard. So when you get the settings right, so like me now, I can use a simple moving average. Maybe I use simple moving average of 5 and 10 moving average. But when I get to the practical aspect, I will be able to tell you how I use my own moving average. Like the exponential moving average, I use 200 moving average. This 200 moving average I use to determine how far the trend of the market, how far the market is going. So we move. Let's move to the next slide now. Yeah, this is another powerful indicator called the Bollinger Band. Bollinger Band is very, very powerful indicator. Bollinger Band is a technical tool that helps to measure volatility of the market. Bollinger Band is a very good tool. It can show you the entry, it can show you the exit. It's like Bollinger Band is like a let me show you. This is Bollinger Band. Bollinger Band will give you a proper this is one Bollinger Band. It will be 3. So it will be telling you how the market is swinging up and down, how the market is just moving in one direction or the other. So you're looking at the swinging up and down. So when you see this one swinging, when it touches the upper Bollinger Band, you know that it's going down to touch the lower Bollinger Band. From there you can buy from here, get to this place. So when it touches this edge, it will move to this edge. So then you can also, from this one now, the upper one you sell from here you can buy, and when it gets to this place you can still sell again. So with Bollinger Band you can be doing buy and selling. Just take a look at this one, buy, sell. Look at this, when the market is ranging. Is in fact, Bollinger Band is a multi-dimensional, it's a multi-trading system, because it's a very powerful indicator. When we get to the practical class, I'm going to show you some of the settings that we can use to trade Bollinger Band. One of the most powerful tools, another one is called the RSI. We call it Relative Strength Index. This Relative Strength Index is very, very important, because it gives you, like the way I use it in the I combine it with the moving average. While the moving average is giving me my entry, RSI will be giving me exit. In other words, I use moving average to place a trade, while I use RSI to exit the market. So in the practical class, we're going to demonstrate that live, and so so we'll be able to determine how to use it. We might not really discuss what is on this slide to details, because RSI is more of a practical. It's more of practical class than theory. But one of the basic principles of RSI is all about overbought and oversold position. RSI is like a graph. It's always under the chart. This is my RSI. It's always under my chart. So at this, there's a particular level whereby you get to this level, this place. Let's assume that this place is 70 and this place is 30. At this level, when the market gets to, when this graph touches 70, it's called oversold. It's an oversold position. Any trader that is buying at that time should be thinking about exit of the market, should be thinking about how to exit the buy, so that most of the people that wants to sell should be thinking of joining the sell. So when it gets to 30, that is oversold, an oversold position. So anybody that is selling at that time should be able to prepare to exit the market, or when any buyers that wants to join should be prepared to join the buying class. So if you must make progress in the forex market, you must not stop learning. And we have so many settings for all these indicators, because majority of them, every day people get advanced. All you need is just like a particular settings that is faster than the candlestick. Most times when people ask me that, how do you get these settings, we work basically on the back testing of these technical indicators. At the same time, when we back test them very well, we test them for not more than 6 months, so that we can know that we want to identify a particular indicator that is faster than the candlestick. So let us recap. Now we started from price action. Price action is just like a system whereby you use the past record, past price movement to identify the present, so that you can use it to predict your future. We also move down to what we call the market sentiment, the way market behaves. This market sentiment, they just behave in a normal manner. Like if the market sentiment can be a bullish market, which means that the buyers, they dominate the market, or it can be a bearish market, which know that the sellers dominate the market. And we talk about the difference between the market sentiment and fundamental analysis. This fundamental analysis is based on facts, maybe an economic fact, maybe political instability, an economic situation in a country that will affect their monetary policy. So it can go a long time affecting them. It's also different from market sentiment. When you see a market sentiment, you should not say that, oh no, we have is a fundamental issue. No, it's always very different. And we also have what we call the trend, the resistance and support. when the market is going up in an upward direction, it will meet an obstacle on the road. When it meets an obstacle on the road, the obstacle is called resistance. While the market is going down, maybe a candlestick is going in a downward direction, when it meets an obstacle in a downward direction, it's called support. At the same time, we can have what we call the uptrend, a sequence of events, a repeated event of price movement, or an arrangement of a candlestick in an upward manner is what we call the uptrend. So when it arranges itself in a downward manner, it's called the downward trend. So which we can use that idea to trade the forex market. So we move to what we call the technical indicators. We are going to, in this indicator, we talk about these technical indicators. They are already on the MetaTrader 4 or 5 platform, but the only thing is that the settings, it's always on a default settings, but we can also reset it to our own taste. But at the same time, for the sake of this training, we're not going to talk about much indicator. We're going to talk about the few of the indicator that is very, very relevant, because when you use too much indicator, you can get confused. But at the same time, the one that I've used and it is working practically, and all these indicators, we also have the custom type, the one that is built based on the principle of this indicator. Maybe we have the custom, we have the cost of, we talk about the moving average. Some people have custom moving average. This moving average, you don't need to set it. Immediately you import it and install it on your MetaTrader, it will be resetting and calculating itself automatically. We have RSI. We talk about the moving average. We talk about the RSI, which is relative strength index. We talk about the Bollinger Band. So for this training, we are going to discuss and dwell deeply on these 3 technical indicators plus the demonstration of a price action. There's also what we call this resistance and support will be demonstrated as we have a particular custom indicator that demonstrates the resistance and support so that we can get our pivot point. All these things we are going to discuss before the end. So at the end of this section, at the end of the program, we should be able to identify market without discussing with anybody. And so in this is where we're going to stop for now. But at the same time, our next class we have to talk about strategy. This is where we're going to continue. This is then in our next class we start from strategy, but for today this is where we're going to stop. So we move on in the next class. Thank you very much.